If you recall, this is the adjusted trial balance that we use to prepare the financial statements. One key thing you should see is that we still have all revenues, expenses, and dividends on this adjusted trial balance, and our retained earnings account for this brand new company didn't even appear because it was a zero balance on the adjusted trial balance. What that means is all these temporary accounts need to be closed into retained earnings. So one key thing you need to be able to do is identify which accounts are balance sheet accounts and therefore are permanent, carrying their balances forward from period to period, and which ones are temporary. Take a moment and see if you can identify all permanent accounts. Hopefully you're able to do that. Here's your answer. All these are accounts that will appear on the balance sheet and therefore are permanent. Therefore, at the end of one accounting period, for example, December 31st, whatever the balance is in these accounts, that will be the beginning balance for 11X2. Now, these other accounts are not permanent accounts. These are temporary accounts. Stop the video and see if you can identify which of these temporary accounts are income statement accounts. Hopefully you're able to do that. The income statement accounts are all revenues and expenses. Other income statement accounts are gains on sale of long-term assets or loss on sale of long-term assets, as well as contra revenues, which we haven't really discussed much in the course yet. Now, another temporary account, which does not appear on the income statement because it is not a revenue or an expense, is the dividends account. This account only appears on the statement of retained earnings, but once again, it influences how much of the company's earnings the company retains. So net income increases the amount of earnings the company can retain, and dividends reduces the amount that they did retain.